Hello, everyone. My name is Matthew Stearns. I'm the founder of Brookhouse Advisors located in Meadville, Pennsylvania. Thanks so much for joining us today. Here at Brookhouse, we're a full service wealth management and financial planning firm, and we specialize in faith based investment strategies and also Christian financial planning. But we've been wealth managers for 8 years now. And in this presentation, we're going to talk about the financial markets and the economy. And this is meant to be a very comprehensive view of all of the markets and what's going on today in our world. So we're going to be talking about the stock market, the bond market, cryptocurrency, gold, tariffs, war in the Middle East, etc. So this is really meant to just be a moment where I can share my thoughts and opinions and hopefully give some people some information that will help them guide their decisions into the future. And I have to say that none of this is intended as investment advice. This is just informational only, and you should consult your advisor if you have one or do your own research. And I'm going to be giving my opinion about where I think we're going and what investors should expect in the future. But that's not necessarily advice to go out and make a trading decision on it in the near term. Things can change, things can go on for a long period of time without changing. So it's not meant to give any guidance on what you should do today or in the near future, but take with this what you will, and we'll get started here. Okay, so let's start by looking at the U.S. stock market. Here I have a chart of the S&P 500, and you can see we're looking back here to 2006. I just threw up there about 20 years of history on the S&P 500, just so you can see what it looks like over time. And the S&P 500 is the index that we use to describe the United States stock market. It's the largest 500 companies weighted by the size of the company. So the bigger the company, the bigger weight that it has in the index. So your large tech companies now make a large amount of the index, a disproportionate amount. And in fact, the large tech companies, the top 10%, the top 10 companies within the index now represent the largest portion of the S&P 500 that they ever have. So that's just one little footnote there. But you can see here, we have the great financial crisis, went from about 1,500 on the right. You can see that to about 750. That was a 50% decline. We've had pretty much a accommodative Federal Reserve, 0% interest rates for the entire 2010s and basically a straight line up until we have the COVID dip. We get a massive influx of liquidity from the government and the Federal Reserve, sending out checks, lowering interest rates all the way to zero, buying up bonds in the open market. Big boom. And then we say, oh, snap, we created inflation. We're going to have to hike interest rates. The market didn't love that, had a drawdown. We sat around and said, okay, you know what? The market seems like it can handle it. Everybody locked in their 3% mortgage. Companies locked in really low debt during this 2021, 2022 timeframe. And yeah, actually, corporate profits are really good because they have all of this very low interest bearing debt. Consumers are okay because their mortgage payment just went down because they got to refinance. And then we have a big boom here, 23, 24. This year, the stock market's up about 8%, reaching all-time highs. It's about at 6,500. Shook off the tariff news really easily. And that's where we are today. So investors have been, I think, rescued in the last 5 years now. We're in 2025. Since COVID, well, even prior to COVID, since great financial crisis, investors have been accustomed to very easy financial policy that's been really smooth on corporations, 0% interest rate policy or very low interest rate policy. The 2010s were extremely smooth for investors. And then both times we got a crisis here, COVID, even with this tariff news, every time something happens, we're getting a quick injection from the Federal Reserve or backtracking from the federal government. And so investors have gotten very comfortable over the last 15 years with rising prices and the market's just powering on ahead. We'll talk a little bit about valuations, but in contrast, I want to show you what's happened in the bond market over this exact same time period. So we can see pretty clear rising prices. Now, the bond market won't go up dramatically in price because it's paying out most of what it earns is in interest. So investors are expecting interest payments as opposed to capital gains in the stock market. So you have to differentiate that a little bit. But coinciding with the zero interest rate policy that we went to during COVID, and also the Federal Reserve buying up a lot of the bonds themselves and putting them on their balance sheet, we had this massive explosion up in the bond market, record highs, and then a little trickle down. And then, oh, we realized that we created double digit inflation. We're going to have to hike interest rates extremely aggressively, and the bond market cratered. So, obviously, by looking at this chart, you can tell that interest rates going up is bad, interest rates going down is good. Okay, that's just fundamentally how the bond market works from a mathematical standpoint. A lot of the bond market trades on mathematical presumptions. The stock market is a little bit more about future optimism, sentiment, and projected cash flows. The bond market's a lot more mathematical. But look at the level we're at. We're down here at 98. This is the same level that we were at in 2005. I can take this back, I think, a little bit further. Well, it's not cooperating right now. But levels all the way seen back at the beginning of the century, and from a huge drawdown that we experienced from the highs in 2020. So the bond market experience has been the complete opposite of the stock market experience that just keeps powering upwards. This bond market performance from 2020 to 2023, basically, and then it's gone sideways, is the worst bond market performance that we've ever experienced in the history of the United States. So investors, I think, don't ruminate on that enough. Basically, they're just focused on what's been working and what seems to be going up all the time. But in the long term, we have to think about this trade-off of the fact that stock market's powering through new all-time highs, valuations are going up tremendously. We'll talk about that in a second. And the bond market, on the other end, is at an all-time low relative to its valuation and just experienced the worst crash basically in history. So you have to think of it as an investor, as a long-term investor, which is offering me the best risk-reward trade-off here. And we're going to talk about that in a second. Okay, so now we'll take a look at what Warren Buffett is actually doing over at Berkshire Hathaway. And Warren Buffett, he is basically the chief portfolio manager at Berkshire Hathaway. He's recently stepped down in his head role, but he obviously exerts a huge amount of influence. But you can see here on this chart that from basically the start of last year till now, he said, okay, we're going to stop buying publicly traded companies because they're too large, and we're just going to hold it in cash reserves, which are basically treasury bills, and just wait for this thing to settle itself out. Okay, so what Berkshire Hathaway does is it buys companies or it buys stock. That's really what he does. So he buys privately owned companies, and Berkshire sometimes even runs them, or he just buys stock in publicly traded companies. Like he's famous for owning a lot of Apple, a lot of Bank of America and Coca-Cola, things like that. But what's happening when he's raising this much cash is he's fundamentally saying, there is nothing that I can find that I want to own that's a good deal. Warren Buffett is the all-time best value investor, which is to just say he likes to only buy things when they're cheap and definitely undervalued, and then he waits for them to reappreciate over a very long time frame. So that's very contrary to the way a lot of this world works, where people just buy what's super hot and try to ride the momentum. He does the contrary. He buys things that are extraordinarily cheap. And when you see this huge cash buildup like this, it's Warren Buffett telling everybody in the world, saying, there is nothing that's available for sale right now. Nothing that I want to own that's available for sale. And we would tend to agree with him. We've been saying this since before he started accumulating cash. And you have to understand, too, this is even more dramatic because with his cash, okay, Berkshire Hathaway can actually use their cash to buy their own shares of stock, okay? And when they do that, they actually increase the value of the stock price because they're reducing the amount of shares. They basically expire them, and in return for expiring that cash, they make the value of the stock go up, okay? They buy out their own shares. So even Warren Buffett is sitting there himself saying, we don't even think our stock is well priced. We don't even want to buy back our own stock. So that's how kind of crazy this is. And if you don't want to take it from me, take it from the man himself, that there's really intelligent money sitting on the sidelines and saying this market is really expensive. Okay, so this is a really fascinating chart here. This is a chart that was produced by Vanguard themselves. So Vanguard is a huge asset manager. They own trillions of dollars in assets, and they were basically the ones that promoted the idea of passive investing, buy and hold the S&P 500, set it and forget it. That's really permeated our 401k culture and really the entire financial marketplace nowadays. But even they came out with their 10-year annual return projections for a variety of asset classes, and it's pretty shocking. So here they have US equities expecting a 4.8% return. So the average 100-year return for stocks is 10%. Okay, and investors now even expect higher than that because they're so used to it from 2010 up till now. But the average return over the last 100 years is 10%. And they're saying investors should only expect 5%. And then a little bit more for global stocks because their stock market's not as expensive. Growth even less, 3.5%. But what's fascinating here is look at the bond market here. They're saying that the US bond market is expected to return the exact same amount. So they're saying, okay, you can replace your stock market investment with the bond market here and expect the same return with much less volatility. Look, the volatility is 6.3 versus 15.2. You don't have to know exactly what that means, but they're saying there's less than half the volatility in the bond market that you can expect the same return over the next 10 years. So this is really fascinating from Vanguard. I'm just trying to give you some other opinions other than my own, saying the stock market's very expensive to own right now. But I think it's striking that Vanguard put out these projections. And the implication of the stock market returning on average 5% over the next 10 years isn't to say that it's going to average 10% in a very linear fashion. It's likely that you're going to be looking at a large price correction and then a rebound that will end up averaging out at 5%. And once that big correction happens, then the forward looking return from that moment in time will be much higher. Because, for example, if prices went down 50%, the expected return would then go to 9.6. Okay. So listen to what I just said there. Mathematically speaking, if investors want the average return from the stock market over the next 10 years, prices have to go down by 50% just to meet the historical average expectations. Okay. So that is where we are. Vanguard is coming out in the open and blatantly saying the market is overpriced by twofold. Okay. And we think that math is probably pretty close. So what's likely to happen is, you'll have some correction and then the math will completely change and then the forward looking returns will be much higher, where investors could probably expect a much more level type of return out of the bond market and avoiding all that volatility. So I've been saying it for 2 or 3 years now that the bond market offers a much better risk reward than the stock market over this next 5 to 10 year time horizon. And we've just gotten to a point where investors are so conditioned to the large returns that we're getting in the stock market, these 20% returns, that they just can't pull the money from that market and put it in the bond market and get their 5% and be happy. But we think that over the next 5 or 10%, you will do much better as a bond market investor. If we do have a large stock correction, you can then move your money from the bond market where it would not have declined or maybe even have appreciated and then buy stocks at a cheaper price. But we're willing as a firm in general. Now I have clients own stocks and we're not like 100% in bonds or anything. But in general, we think the trade-off greatly favors the bond market right now. And people are too highly levered to the stock market and should just consider the trade-offs and the risks that they're choosing right now with the market at all-time highs. And this isn't to say that the market can't go higher. I actually expect, in the short run that the market will continue to reach new all-time highs. But at this point, we feel like the stock market has really turned into a Ponzi scheme. And I don't say that lightly, but essentially what's happening is everybody's just passing the buck on to the next person and just saying, hey, we're going to keep these prices going up until someone says that the party's over. So it's kind of like musical chairs where the music's still playing. I'm buying the stock market. I'm going to hope I can sell it to you at a greater price until basically the music turns off. And then you have a cascading effect downward where everybody's trying to get out. They'll be moving their money from the stock market to the bond market. But we think that won't happen until we reach really euphoria levels. So a lot of people think there's going to be a recession. A lot of people think that the market's overvalued. It's kind of commonplace. And what happens is when you have a situation like that, actually, it causes the market not to go down because there's people kind of fighting it on the way up. The real scary part is when everybody is extremely optimistic. Everybody thinks that the stock market's just going to keep going up and up and up, and there's great euphoria. So we think there is some euphoria in the market, but it can go to even higher heights. And I would not be surprised to see the stock market go 10 or even 20% further from here. But we think that ultimately the correct price level for the market is around 3,000, which is exactly what Vanguard is saying here. They're saying that the price needs to go down 50% so the average return can be 10%, which an investor should expect, which means a pretty substantial stock market decline at some point in the future. Okay, and you have to decide if you want to continue playing the game and participating, or if you just want to relax, get your 5%, and wait for things to shake out. And so that really has to do with your temperament, where you are at in life, what your preferences are as an investor, and all kinds of things. So I'm not saying, sell, or anything like that, but just be cognizant of the risks that are present right now. Okay, so looking further at the bond market, we really have to understand what's happening with inflation and interest rates. As I said before, the bond market will appreciate in price when interest rates go down. Okay, and you can see on this chart a history of interest rates where we went from the 50s, we had low interest rates after the war, crescendoing with an oil crisis where oil went bananas in the 70s. Inflation went super high. They raised interest rates to 18%. And since that timeline, we've been on a 40-year downtrend down to zero. Okay. And this is really important. Investors have gotten really comfortable with declining interest rates basically over this 40-year timeline. And this cycle can reverse itself. We can go back to a cycle of rising interest rates. And I think we will do that. That will be an entirely different world for all investors, but not yet. I want to focus kind of here more on the right side of the picture, which is this blue line represents the Federal Reserve interest rate, the overnight rate that you hear talked about all the time. Okay, right now it's at 4.25. The green line represents CPI or inflation. Okay, so let's just look at kind of what's happened in the past year. Federal Reserve in 2000 raised interest rates just slightly, caused a recession. That's this gray bar here, and inflation fell. Okay, 2007, 2008, interest rates were down at 1% to 2%. They said, hey, we need to get interest rates up here. What did it cause? It caused a massive housing bubble. You have basically financial bankruptcy, great financial crisis. Interest rates are cut to zero to save the economy, and inflation comes crashing down. Okay. Then we have 0% interest rates for the better part of 7 years. We try to raise them. Actually, this happened in 2019. We actually had a very brief recession that was kind of forgotten about because of COVID. Slapped interest rates down to zero again. And then look at this massive rise going back historically. We go from zero all the way up to 5% in response to this huge spike in inflation. So what happened in COVID was really unique. We had this massive spike in inflation, and then we have inflation coming down, but interest rates still very high historically. So basically, as a bond investor, you're thinking, I think this is a good investment as a bond investor if this blue line's coming back to zero. Inflation's been falling down. We think that inflation is not a material concern. I'm going to share that on the next slide. But we think that this blue line comes crashing back down to zero, basically because the federal government has no other choice. Our debt is too high. We can't afford to finance our federal debt at 4 or 5%. We have to get it down to zero. The government has basically committed to printing money and debasing our currency. And that's what they'll continue to do. That's what happens at the end of financial empires. And that's basically what's playing out now. We think rates will go back to zero. It will pay off enormously for bondholders. And then after that, we think they'll be printing so much money now, it'll be even worse than during COVID. We'll have extremely high inflation. They'll be forced to raise interest rates beyond 4.5%, because at this time, inflation will be so bad that people will really be hurting. It'll be another degree of pain, and that will bring about a great amount of financial reset where the government will not be able to print money. They will not be able to run fiscal deficits. We just don't think it's this time around. We think we got one more go. We think we have one more recession. We save the economy one last time, bang interest rates down to zero, print a bunch of money. But this next time, because of the way that debt economics work, you have to print more, you have to provide more liquidity than you did in the past, because the pie that you're trying to fill in and stop the water from leaking out of is bigger than the last time you did it. And it's just a vicious cycle. But we think they can do it again. Believe it or not, we think they'll go back to zero. Inflation isn't an issue, and it'll pay off for bond investors. And when all of that chaos is happening, it won't be good for stock investors. So that's another reason why we're more optimistic on the bond investing side of things. Okay, so here we have a quick look at the CPI. You can see from 2020 up to 2022, we've had inflation up at 9%. It was almost definitely higher than that. Our inflation rate is a lie. It's materially underrepresented because the government basically calculates a lot of payments. And one thing in particular is the Social Security payments are rated based on CPI. So the larger CPI is, the larger the rate of inflation, the more they have to pay Social Security recipients. So that's one of the reasons that it's pressed downward. Also, the lower the inflation rate, the higher they can say that real GDP is, because GDP is the growth of your economy minus your inflation rate. So if you say that, the economy grew at 4%, but inflation was 2%, then the real growth is only 2%. Well, if you say that the rate of inflation was actually 1%, then it sounds like real growth is 3%. So they have all these incentives to underrepresent inflation. There's really good metrics we can look at to say, what inflation really was. It was definitely higher than this. But all that being said is actually now inflation has come down dramatically. It's been between 3 and 2%. In the real world, actually, we think now inflation is shooting on the high end, and inflation is actually in the 1%, between 1 and 3%. Now that's still increasing prices in this world. It's just increasing very slow. So we don't think that the Federal Reserve has an inflation problem. And we actually think that the interest rate level that we're at right now is much too high. So we think that real world inflation's right at 2%, which is the Fed target, but their interest rates are 4.25%. It's too hard on the economy. We're seeing a housing market slow down in the major metropolitan areas across the country. Austin, Nashville, Florida, they're seeing home prices go down someplace already at double digits. So it's lasted long enough that these interest rates are starting to have a material impact on our economy. And we would say that they've gone on too long. The Fed is behind. They do need to lower interest rates. This has nothing to do with agreeing with Donald Trump about it, although he wants them down to lower the national debt cost payments, which is valid. But we think they just need to go down because they're putting too much pressure on the economy. The Federal Reserve doesn't think it's putting pressure on the economy, and we think that they're totally wrong about this. So we don't see an inflation return. We think that rates have to come down. This is just more bullish information for the bond market investor. But when we see the market start to think about the interest rates coming down, we think that the stock market has a reflex to perceive that as being very good. Interest rates coming down, less debt costs, people can go out, refinance things, borrow for things. So the initial knee-jerk reaction of rates going down is positive. So we actually think that the initial news of rates going down, whether it's September, October, November, at the end of this year, it seems like they're going to be going down somewhat. We think that that will be greeted by a stock market rally. But what people aren't going to realize is that underneath the surface, the economy is slowing, and lowering interest rates takes a long time to come through the economy, and that the economic growth is extremely slow right now. And we have labor market problems, and that they're actually still way behind the curve. So unfortunately, the problems are greater than what the stock market's going to perceive at first, and then we think that later on we'll see a recession by the end of the year or in 2026, even maybe as far out as 2027, depending on what kind of fiscal stimulus that we get. Okay, finally, we're going to end by talking about gold. So this has been a massive outperformer here. So you can see that we had a great run up in gold up to the financial crisis. It actually fared fairly well. And then we had this big trough here where people kind of forgot about gold. The stock market was doing really good, went sideways. But since 2022, so basically since that bond market decline, gold has been on an absolute rocket ship. So you can just see this huge, massive breakout here, we would call it, from around the 2000 level to 3400 level. And I've been a gold bug most of my career. We were buying gold in clients' accounts all the way back here in 2018 and 2019. We bought gold, I think, for some clients even at 1200. And I've been owning it in client portfolios ever since. I think it's something that most clients should have 10% of gold in their portfolio, basically for all time, no matter what age you are. But it's actually outperformed the stock market the last 2 years, and the stock market's been performing wonderfully. But it's easy to look at this and say, this has a lot to do with the dollar debasement and things like that. But we think that there's a couple things going on here that most investors don't know about. The first is that there was a banking agreement signed by all the major world banks. They're called the Basel Rules. And in the new Basel Rules, basically they recreated gold as collateral for money. So it doesn't mean that money's backed by gold anymore, but it does mean that banks can lend against gold. So a central bank, or I'm sorry, not a central bank, but a commercial bank can take gold, a bar of gold that's worth, $500,000. I think a whole bar of gold now is worth close to $1 million. But so they can take it and then they can make a $10 million loan against it, based on the fractional. They only need to have 10% of assets. So gold now has become an asset that they can lend against as collateral. So that's one thing. The second thing is central banks want to own gold now instead of owning U.S. treasuries because of what we did to Russia, okay? Not because that they don't think the U.S. government isn't going to be able to pay its bills. That's maybe a very small part of it. But basically, most of the world says, hey, the U.S. can just sanction us whenever they want. They can, not give us our money back when we have it sitting in U.S. banks on U.S. soil, just like we did with Russia. This was a humongous blunder, should never have happened. And now basically countries are saying, all right, we don't want to own U.S. treasuries because the government can just not pay us our interest on those treasuries. We'll just own gold instead, and we can lend against it. So that's number two. The third reason is that we think that gold, unfortunately, is telling us to expect more kind of global chaos geopolitically. So we think that it's a negative sign saying that, war is here, war is going to continue, and let's all pray that this isn't the actual outcome. But gold has a history of kind of predicting geopolitical events. We see still massive risks in the Ukraine, unfortunately. As I'm recording this today, Trump's meeting with Putin. And, it's a really difficult negotiation. Russia's clearly winning the war. If you're not getting good news sources, they've basically got control of the whole Donbass region and Crimea. And they really have no good reason to give it up. The Europeans, they're unwilling to cede any ground because they're afraid that gives Russia a reason to invade other parts of Europe. And in general, the leadership of Europe are warmongers. I've lived in Europe. I understand how the leadership there thinks, and it's pretty sad for the people of the Ukraine. And at this point, basically, NATO is fighting a proxy war with Russia, sending money and weapons to Ukraine, letting Ukrainian men die to weaken Russia. But regardless, Russia has taken the Ukrainian territory. We don't see it coming to a good end because we think that the only reasonable truce right now is Ukraine ceding that land back to Russia and everybody walking away and saying, all right, we're just going to deal with this new reality. But we don't think I don't personally think that Europe's going to let that happen. So I'm afraid of escalation there. And I don't think that the escalation in Israel or Iran is finished yet. You're starting to invoke religious war, which is the worst kind of war. Basically, has no resolution except utter destruction. So I fear that the gold price signal is warning us of more trouble to come on the global front, and let's just pray that's not the case. I have my own internal models that I created to measure the fair market value of gold. And even in 2019, I think I said that the fair market value of gold was 2,800 when it was like at 2,000. And I said that silver was about 45. And remarkably, after this huge run up, actually gold's through my price target. So right now we think the fair market value for an ounce of gold is about $3,000 and silver is about 50. So silver is still undervalued, but it's just shocking to see the metals finally catch up to that. So we think that after this big run up, the metals are pretty reasonably priced actually, but they still offer a tremendous amount of protection in a portfolio. They're the ultimate chaos hedge, they're deflation hedge, they're recession hedge. It's good money. I would own it personally if you can get your hands on it. It's just a good thing to own. So we are in favor of owning the precious metals long term, but here I think this big run up has kind of taken a lot of the upside out of it already if you've kind of missed this run up. So finally, we'll say a few things about crypto. I know it's on some people's minds. There was a huge dip down to about $16,000, $17,000 at the end of 2022, and now it's at $120,000. So it's just another one of those things we're seeing in our world today with just massive gains. People are bought into this euphoria that it's just going to keep going up and up and up. And right now, we think that, like I said with the stock market, I wouldn't be surprised to see another big jump up, kind of a last euphoria. And when you get people saying, Bitcoin's going to 1 million this cycle, it's going all the way, it's going to replace the dollar, things like this, you're probably getting closer to a top. I think people are still kind of cautious about it. I think we need a little bit more euphoria till we get a big crash. But the thing that hasn't happened with Bitcoin is we haven't had a real recession where we actually have negative GDP and a sustained downturn economically and liquidity drying up. So regardless of the price of Bitcoin going from $120,000 to maybe $200,000 this year, I think that in the future, we'll see Bitcoin all the way in a recession back down in this area, back down to these lows before, maybe even down towards the $10,000 range. It's just not built for a recession. It's massively tied to liquidity. It's tied to the US stock market. This isn't to talk about the long-term prospects of crypto or Bitcoin. There very well may be a place for it. It may become the digital gold version, but I think in a recession, you will see Bitcoin decline dramatically, and that might be a final chance for you to buy it at a reasonable price. So I wouldn't be surprised to see Bitcoin take a huge leg up here. And then in recession, whenever we get it, next year, 5 years from now, whenever, you'll see Bitcoin's price crash 90%. I would not be surprised about that. So that's our viewpoint on crypto and just risk assets in general. So I'll just wrap this whole presentation up by saying that, let me get out of the screen real quick. So we would just like to say in closing that in general, we feel that US risk assets are extremely highly priced. Does not mean they can't go higher. The government is still facilitating a lot of liquidity injection into our economy. The government's going to run a $3 trillion deficit, which is just a tragedy. I'm really disappointed in the president. It was a chance for the Republicans to step up and, apply some fiscal and financial discipline to our situation, but they went the other way. They're going to keep the party going. At this point in time, we take in about $5 million in tax revenue, and we're spending $8 trillion across a myriad of things, and nobody wants to fix the problem. But that $3 trillion of spending, that deficit is being added to our debt. Okay, so that's where you're getting the $37 trillion in debt. But on the other side of things, it's going into our economy. Okay, so this is the thing that people don't want to reconcile with is this deficit spending that's adding to our debt that nobody wants is pumping up our economy. Okay, so this is the real situation that we're in. And the government is continuing to do it because they're not feeling the repercussions of it. And we're at a $3 trillion annual deficit. And this is in really basically good times financially. I mean, the economy is not great, but we should be running a balanced budget right now, because what will happen in a recession is typically tax revenues fall 40%. So you'll get a tax revenue of 5 trillion going to 3 trillion, and then you'll get spending going from 7 or 8 trillion up to 10 trillion to try to bail us out of the recession or whatever kind of situation we're in. And now you're running a $7 trillion annual deficit. So this is why you can't run a deficit in a good time, because when things get bad, you run a huge deficit. And so this is an absolute economic disaster. There will be a reckoning for this. You cannot print money into oblivion. Eventually, interest rates will have to rise because nobody will want to own government debt. And this is what happens in emerging markets. This is not something that I think is going to happen in the next year or two. This is something that's going to happen over the next decade or so, play out. But we had a chance this time, I think, to apply some fiscal discipline. Musk was on the right path. They need to make some hard decisions with Social Security and Medicare and defense, but that's the reality of the world we live in. But they decided to punt the ball, and we're living in a time of monetary confusion where people don't understand how money works. And it's actually not that simple, or it's not that difficult. It's rather simple, but nobody has the discipline to get us out of the economy because the incentives aren't there. So the party goes on for now. I'm not surprised if risk assets go up, stock market can go up, Bitcoin can go up. But we think that with all this debt that we have, the Federal Reserve interest rates are too high. They have to come down. It's putting too much pressure on the economy. The economy's slowing and the Federal Reserve is not aware of it. This could lead to a decline in risk assets, stock prices, and cryptocurrency prices going down. We think that the bond market will do well. And we also think that the stock market declining will actually be a reinforcing wheel that will dry up economic activity even more, because we think a lot of the economic activity is supported by really high stock prices, baby boomers retiring early, spending down their 401ks that they had saved up because they all have $1 million in them, whatever it may be. But as these things start to decline dramatically, they'll say, okay, we can't spend that money. Then the hotels aren't getting paid, the restaurants aren't making money, their profits are going down, and it can have this reinforcing effect. So we call it the wealth effect. Stock prices going up, everybody feels like they have money, they spend it, and it helps the economy. Stock prices going down. So we think that once we get some kind of information or impetus that people say, okay, we think we don't want to own stocks anymore, we'd rather own bonds. Once that trend catches and gains momentum, we think it can be really hard and fast to the downside. And we think that, just based on price, not based on a recession or anything, that the stock market is about doubly overvalued what it should be. That's not to say it can't go up tremendously from here, but we think at some point it has to come back down to earth. So we're going to leave you with all that information. Make those decisions as you will as an investor. You have to decide, how you want to play the game, what's your time frame, what's your risk tolerance, and all those things. But hopefully you took away some good information for this. Thanks again for watching. My name is Matthew Stearns from Brookhouse Advisors, located in Meadville, Pennsylvania. You can find me on the internet. Reach out to me to my personal email, matt@brookhouseadvisors, and I'd love to help you any way I can. So thank you, and have a great day. Good luck to you out there.